Hey guys, I hope you guys are trading well here and you're all paper trading. I hope you've all paper traded before you started actually allocating real money to trades. I have a very special presentation today. Basically, there are four risks to this type of business, and I'm going to share all four risks with you today. These risks are something that you really need to keep an eye on as you develop your business. They're not something that are terribly intuitive, but these are the things I've learned while doing this business and by creating these business opportunities. When creating a business, an investment business, we manage, remember, by the numbers. The numbers are everything. Now, every business understands what their product is. You have to have a very good, firm foundation of understanding what your product is. In this business, your product is calls and puts. Okay, this is the stuff that we deal with, the product that we deal with. We're selling options and we are buying options. We are a business that buys and sells. Anytime you're in business, you have risks. The four risks that I'm going to talk about today is concentration of risk, overlapping trades, allocation of capital, and finally overtrading or over adjusting positions. Let's take the first one, concentration of risk. What I mean by concentration of risk is that you have almost all of your profit potential centered around a single strike price. For example, I have currently on the screen our portfolio with the symbol IWM, so it's weighted against the IWM. As you can see, we have a fairly wide range in which the IWM can move and we could still profit from this position. And if we dig down into this position, I can show you that we have a lot of different positions on. There are all kinds of different positions here. Concentration of risks means that, let's say at the 73 strike price, you have a very large position at the 73 strike price. You sold a number of calls, and I guess size all depends on the capital that you've allocated for this business. But let's say $5,000 is a lot of money to you. Well, if you have $4,000 of your money tied up in margin, and they're all centered around the 73 strike price, whether you've sold them as calendars or you've put on different types of spreads or a sale of a vertical spread. If you have all of your risk concentrated around the 73 strike price, what you're doing is you're concentrating your risk at that point, so that if prices move way down or they move way up, you're probably not going to have the same type of profit potential as if you had a wider range in which you could profit from. So that's concentration of risk. Concentration of risk means having a lot of contracts or size position for you, and that could be, if your capital allocation for this business is $5,000 or $20,000 or $50,000 or $100,000 or $500,000, it doesn't matter. If you have a large position that you would consider large at a single strike price, you have concentration of risk, and that's very dangerous. Prices can move dramatically against you very, very quickly, and if you have a concentration of risk at a particular strike price, you're going to get hurt. The second thing I want you to be aware of is something called overlapping trades. Let's take a look at our inventory again for the IWM. As you can see, we have a number of different positions here. We've sold, most of these are calendars and double calendars, so we have the 67 put in May, we're short 2 of those, we're long 2 of the 67 puts in June, we're short 2 of the 70 calls here, we're long 2 of the 70 calls in June. So there's lots of calendars here, but you can see that they are all basically at different strike prices. And they're different options. One's a put, one's a call. Let's say you had an idea for an adjustment and you were running up against your break-even points on your profit picture, and you decided that you were going to go ahead and do an adjustment in which you were going to buy 4 of these 67 puts and perhaps sell 4 of the 69 puts. So you were going to do this for a credit. On the surface, it sounds like a pretty good idea, but here's what's going to happen in reality. Since you are short 2 of these 67 puts and you buy 4 of them to protect your short 69 put position on a vertical spread, then you're actually, what you are doing is having a net positive 2 67 puts. The 4 that you're buying will eliminate the 2 that you're short, and you'll have a net 2 67 puts in May. That will have unintended consequences for your position. And unfortunately, Thinkorswim's platform will not alert you to the fact that you are overlapping positions, that you have an overlapping position. Now your calendar is no longer a calendar because now you're no longer short those 67 puts. You're not short those 2 puts anymore. Instead, you're long 2 of those 67 puts. Not only that, so your calendar is now no longer in operation, is not active for you, but also you are long 2 67 puts when you really wanted to be long 4 67 puts to protect the 4 that you're short on as the 69 put. It's a very important concept to understand, is that when you adjust your positions, if you're short some puts and you add 4 long positions to the same option, then in fact you are net a different position. And it's very important that you understand that, and the analysis tab may not help you with that. It's not going to pop up a little box saying, oh, by the way, you're short 2 of those 67 puts. If you buy 4 of those to protect your short 69 puts, you're going to be net long 2 puts. Very important concept to understand. So when making adjustments, make sure that you take a look at your trade tab. Look and see where your existing positions are, and if you're short those positions, make sure you do not go long on those positions, basically negating your current position. The third thing I want to warn you about, and the third risk of really this type of business, is the allocation of capital. Allocation of capital means that you have so much capital available to you. In this case, we have, in this demo account, we've allocated about $28,000. Our total, all of our cash is about $230,000, but our actual position for this account is $30,000. Even if you had $200,000, you don't want to spend $230,000 on opening these positions. If you have $20,000, you do not want to use all $20,000 opening these types of positions.